Well, turning back to today's news from Fedex, the second largest package carrier says that it more than doubled its profits in the first quarter. Memphis-based company earned $1.08 in the past quarter on revenues just under $7 billion. Donald Broughton, who follows the stock at AG Edwards, downgraded the stock to a hold from a buy yesterday. He joins us now to tell us why and to offer his outlook. Donald, thanks for joining us. And let me start with this. When you look at the stock today, it's falling more than $3. Is the stock sell-off today more a matter of FedEx not meeting the heightened expectations, or is something else happening here that we're not seeing?
No, I don't think it's that at all. This is a company that raised its earnings guidance 4 times in the last 6 months. So we had some momentum players in the stock. This is a company in which great expectations have been raised consistently, the stock, let's face it, has outperformed the overall market by quite a margin. It's up over 30% so far for the year. The S&P is relatively flat, so you've got fund managers who are looking at a chance to lock in some profit. You've got some momentum players that decided to leave. And then yesterday morning, before the market opened, we went back to a hold from a buy, simply because we'd seen the realization of an expansion in valuation and an expansion in earnings expectations. Do we expect great things for FedEx? Sure. But we think the rest of the market does as well. And let's face it, investing in Wall Street is an expectations game.
How much upside does FedEx have in earnings growth, do you think?
Well, I think there is upside, but I think it's marginal compared to what it was really at the beginning of the year. They're going to produce $4.40 to $4.60 this year. Could that number be slightly higher? Maybe, but that's a pretty prodigious increase over last year. And how high is what we're arguing about.
So let's talk a little bit about what else is happening. The company, is it handling the Kinko's acquisition well? Did you hear sufficiently enough about that for you to think so?
Well, no, but then again, it's still a minor part of FedEx, and I don't really ever expect FedEx to handle any acquisition well in the beginning. FedEx's style when it comes to acquisitions is that they do strategically the correct thing, and then in time turn that strategically correct thing into a real money center. When you go back and look at 1988 when they bought Flying Tigers, I remember looking at that and thinking they overpaid. Yet today, if you look at just the rights to fly in and out of Tokyo, the rights to fly in and out of Hong Kong that they acquired, they stole it. If you look at what they paid for Caliber in 1998, if you look at what they paid for American Freightways in 1999, you would think, well, maybe they overpaid for those, but Caliber became FedEx Ground, which has just been a home run for them. American Freightways became FedEx Freight, which again has been a home run for them. So 2 years, 3 years, 4 years from now, I expect Kinko's to add meaningfully. But in the short term, it's a drag. 3.8% operating margin. Our informal stores survey that we published yesterday morning said we think the stores are understaffed and undertrained. I expect a higher service and better execution from a company like FedEx than what I've seen so far at Kinko's.
Donald, we have to leave it there. We're running out of time. Appreciate it, though. Donald Broughton with his thoughts. He's an analyst at AG Edwards, taking a look at shares of FedEx today. And as we mentioned, the stock has been moving lower in the session by better than $3.